Well, it's 12:01 now. Thank you for taking the time out of your busy day to join us for this EJF learning session. Um, we are going to go over insurance market updates and strategic budgeting, which is fitting given that we are kicking off the budget season very soon at EJF. As always, this meeting is going to be recorded and circulated to all board members. Also, at the end, we will have a Q&A. Please drop your questions in the chat. And without further ado, I'll hand it off to Joey Rice from AIM Insurance. Joey?
Thank you, Sarah. Thank you for the introduction. Yes, my name is Joey Rice. I'm with Associated Insurance Management, and we are an independent insurance brokerage out of Silver Spring, Maryland. And we specialize in community association, co-ops, and apartments. Multifamily housing is our specialty as an agency. So today we are going to go over just an overview of the state of the market and some strategies for budgeting and cost mitigations for community associations. And we'll go into, what kind of questions and items that you need to bring to your agent when asking what should you budget for the upcoming 2026 year. So we're going to go over market conditions and then generally what kind of questions and how can we make sure that we are accurately budgeting for the 2026 fiscal year. So the first thing we're going to go over is understanding the current market cycles. So currently, as many of you are new to the boards and you're not familiar with the insurance market, over the past 3 years, the insurance market has been extremely hard. So we've seen large premium increases, change in deductibles, and we're going to go over kind of what are those core drivers on what drives a hard market versus a soft market. Just a general overview. Right now, I would say we're still considered in a hard market. And there's a little bit of good news or light at the end of the tunnel here. I would believe if you look at it like a bell curve, there's a stock market on a bell curve. The hard market is at the top tip of that curve, we're kind of like still on the higher end, but kind of going down a little bit. So we're seeing a lot of positives in the market. We're not out of the hard market, but we're seeing a little bit more of the positives and kind of seeing more of that tail end of the bell curve going down. So we're seeing some good signs and we'll go through what those good signs are, but we technically still are in a relatively hard market. So the key drivers to a hard insurance market are reinsurance costs, carrier capacity, economic inflation, social inflation, and legal trends. So we're going to go through each one of those market trends. So reinsurance costs and their local impact, right? So when insurance rates are going up, right, some people may think, oh, the big bad insurance company is raising my rates, right? But it might not be the insurance company that you think that is actually raising your rates. So how insurance works is that insurance companies sell their products to insureds or community associations to buy insurance, right? So if you insure your building for $10 million and you buy a policy that insures the building for $10 million, that primary insurer that you're buying the property insurance from, for example, Greater New York, Berkeley, or Travelers, if they're insuring it for $10 million, some of those companies are actually only insuring the building up to $2, $3, or $4 million, right? What they do is they actually go into the reinsurance market and lay off the risk for the additional $8 million over top of the $2 million primary that they're taking the risk for. So the reinsurance costs of that $8 million that the insurance companies have had go out into the market to buy to lay off the risk, those rates have skyrocketed due to the inflation that was driven by COVID over the last 5 years. The reinsurance rates have gone up each year for the last 3 years. We are seeing some indications that those are kind of flattening out a little bit, or the increases are not going up as much as they were the previous 3 years. Typically, reinsurance rates are negotiated right around the first quarter of the fiscal year, so typically between December and January. So we kind of look at that when we do our projections for 2026 on what kind of the reinsurance market's going to look like going into the new year. Right now, we're seeing, again, some positive trends in insurance premiums for renewals that we're currently seeing. That being said, right, hurricane season is upon us, coming up in August, September, and October, right? So you might think, well, again, why does Florida or Texas or California, where the natural disasters affect us, right, is the reinsurers that the primary insurers are buying insurance from for properties in DC, Maryland, Virginia are also insuring properties in Florida, Texas, and California. So when you see a natural disaster in Florida or California or Texas, there is a downstream effect for properties that are buying insurance throughout the entire United States. So that's where the effect of the Florida comes from. Florida losses come from. It comes from the reinsurance market. Another key factor to a hard insurance market versus soft insurance market is just basic economics 101, right? If you have more competition, it's going to drive down rates. If you have less competition, it's going to increase rates, right? So right now, we're still seeing a very limited capacity of insurance companies that are willing to quote multifamily real estate risk, particularly for condominiums and co-ops. There are some underlying factors that really affect the market capacity for each particular association. So what we're seeing right now is those underwriting guideline requirements that have been really tight by a lot of insurance companies have tightened their underwriting guidelines over the past few years have kind of kept them relatively tight, right? So the main factors when underwriters look at a risk to determine whether it's going to be an account that they would consider problematic or high risk is based on a few factors, right? One of the main factors is age and condition of the property. Insurance companies like new, right? So if you have a newer building built within the last 25 years and it's fully sprinklered and it's concrete construction, you are sitting perfect. I mean, you have a lot of insurance companies that'll still quote you depending on your total TIV on how high that gets. When I say TIV, I mean the total building limit. The higher the building limit, the fewer the insurance companies. But if you have a fully sprinkler building that's mid-size, is made of concrete, there's still a lot of insurance companies that'll be willing to quote the risk. The problematic accounts are when you get to the older buildings that the roof, electrical, plumbing, HVAC haven't been updated in 25 years. The building was originally built in 1920s. It was renovated in the 70s or the 80s. It's 8 stories and non-sprinklered. That's considered more high risk and is considered to be to have a very limited number of insurance companies that be willing to quote the account. Obviously, the non-sprinkler factor is due to a life safety issue, right? So if you have a 10-story building that's non-sprinkler, there's a higher probability of having a fatality in your building if the building catches fire, because the sprinkler system in a lot of cases is not there to help put out the fire. It's there to get people out of the building. So if you have a high number of story building and it's non-sprinklered, you're at a higher risk of potentially fatality or injury in the event of a fire claim. So that's where the insurance companies view that as a problematic risk. Another a key factor is a construction type. So when you look at construction type, there's 6 levels of construction. There are 5 main ones. There is frame, joist and masonry, non-combustible, masonry non-combustible, and fire resistive. Fire resistive is concrete construction, which again would burn slowest. So that is the most preferred construction type for insurance companies. And then you have frame, which is made of wood, which once it catches fire, it goes up in flames and burns at a much faster rate. So if you have a frame building compared to a fire resistant building, you're going to have far less insurance companies willing to quote your account just due to the fact that the frame nature of the building is a higher risk factor for insurance companies from a total loss perspective. If you have a fire resistant building, you still can have a fire, but because it's made of concrete, it's going to burn a lot slower. The fire department will get there a lot faster, and the fire itself will cause far less damage than if it's a frame building. Affordable reinsurance costs. So this kind of goes into our last point, and why this really affects some insurance companies is because some of the smaller mutual companies, they have to keep the percentage of reinsurance costs that they pay for under a certain threshold or percentage of the premiums paid by the insured. So if they end up paying such a high percentage of their costs in reinsurance, they can't actually make money off the risk because they can't charge enough for the premium. This is a little bit complex, but insurance companies actually have filed rates with the insurance commissioners. So companies just can't charge whatever they want. They can only charge up to their filed rates. So if they can only charge up to their filed rates and the reinsurance costs that they are purchasing are still exceed the percentage of the expense that they're willing to pay, they essentially can't make money off the account. So depending on how small the insurance company is and how large the risk is, some of those insurance companies can't charge enough rate, which makes them unable to compete or unable to offer their products because they can't make money off an account, which again reduces market capacity for some of the larger properties. We kind of went through this rate inadequacy due to regulation. Like I said, insurance companies file rates with the insurance commissioner, so they can't just willy-nilly charge whatever they want. They have to charge within their confine and rates that are actually filed with insurance companies, with the insurance commissioner. One thing to note, and this is why we're kind of on the soft, we're kind of tailing off the hard market bell curve, is a lot of insurance companies, or a few of the big ones, have filed new rates or new insurance underwriting companies within their company with the insurance commissioner to be able to charge higher rates. So why that's actually better is because of those situations where they can't charge enough rate to justify the reinsurance cost, or they can't charge enough rate to justify the exposure, and then that risk falls to the excess and surplus lines market. These companies are now able to charge enough with the new rate filings with their new companies to justify obtaining those accounts. So some of those accounts that have gone E&S where their premiums have gone up 50 or 100%, now you're gonna have a higher possibility to get those accounts out of the E&S because some of these companies can now charge more than what they previously could charge, which is a good sign. Neighborhood crime scores. So again, this is a huge factor, especially for the general liability or the umbrella carriers. The higher crime rate areas, the lower market capacity for that risk. And one of the more common exclusions that are being added to general liability policies, which is third-party bodily injury or property damage, is the assault and battery exclusion. So assault and battery is pretty standard. If someone is assaulted or hurt on your property due to assault, that would be typically excluded under the assault and battery exclusion. So you're seeing that being added to some of the areas with higher crime scores. Legal costs and jury awards and industry impact. So this is another thing that's driving the hard market. We don't need to really hit on all these too much, but generally speaking, the verdicts for judgments against plaintiffs in favor of claimants have gone up significantly. There's been a much more negative public sentiment towards corporations, erosion and tort reform. So legal reforms that were once cap damages are being challenged or rolled back in several jurisdictions. And then aggressive legal strategies, plaintiffs, attorneys leveraging litigation funding, mass torts, and advertisement and nuclear verdicts to drive up settlement values. So just generally speaking, we're seeing larger summary judgments leaned against parties that have been sued, much higher than what we had seen in previous years. So a general overview of the umbrella liability markets, capacity and compliance and codes. So a commercial umbrella policy, what that is it provides additional liability limits over your commercial general liability and D&O liability insurance. And why we're kind of touching on this, why it's important, is because this market has been hit very hard. This segment of the insurance market has been hit pretty hard over the past few years. One of the products that have been very common for community associations that all larger properties or even mid-sized properties and smaller properties should be part of is the rich purchasing groups. So a rich purchasing group is essentially combining the risk of a lot of different associations so that you can purchase very, very high limits at a very, very reduced rate. So for example, you can get a $10 million umbrella policy in a rich purchasing group for about $2,500 currently, where if you went and got a standard carrier to offer you liability limits up to 10 million, that would cost you anywhere from 15 to 20,000 annually. So you can see why these risk purchasing groups are such a huge competitive advantage. They are a competitive advantage, but they are becoming a lot more restrictive on which risks that they're willing to take on. So the three big factors that could potentially limit your market availability for these rich purchasing groups include buildings that are non-sprinklered over 7 stories, an absence of a central fire alarm system, or no or no 24-hour front desk personnel with enunciation panel. So these are just three things to consider when older buildings and you're looking to maybe upgrade your life safety system. What would be the best thing to do from an insurance perspective? Obviously, I understand that a sprinkler system is going to be extremely expensive to install, and so would a central fire alarm system as well. But a centralized fire system, the centralized monitoring fire alarm system would go a long way from an underwriter's perspective with regards to liability. So if it's something that a board is considering, it would be something that I would consider strongly recommending the central fire alarm system. And it's just good for a life safety. It's really there for someone that's not familiar with a central versus a local system. A central system, what it does is when the fire alarm goes off, it automatically triggers the fire department. Where if a local system goes off, someone has to call the fire department to get them to come out. So that 10 to 15 minute step could really make the difference between someone getting out of the building or not. So that's why having that central fire alarm system really could make a big deal from a life safety or a property damage perspective. And I will say, I went through the general understanding of insurance rates relative to the limits carried. But the good news is we have seen premiums for the umbrella market, go up anywhere from 15 to 30% over the last 3 years. We are seeing a significant premium stabilization just in the last 2 months. So the increases that we're seeing in the umbrella market have been reduced significantly, and there's a good number of risk purchasing groups that are available for most associations. If you fall within the underwriting guidelines, there's now upwards of 4 companies that are writing community associations. Again, their guidelines and the number of limits that they can offer definitely depend on the risk type, but we are seeing a little bit of a softening in the umbrella market just in the last few months, which is a good sign for 2026. Property deductibles and trends in governance considerations. Okay, so this isn't the case for all buildings, but any building that's over 4 stories, we're really seeing a hard push for a $25,000 water damage deductible, which is becoming very commonplace. A lot of this was driven by just due to the construction inflation that we experienced after COVID. It became very apparent that a $5,000 claim 10 years ago is now a $25,000 claim. So that increase that we're seeing in those construction costs are now being felt by the insurance company just on a per claim basis. And the only way for the insurance companies to stabilize the rates as much as they could due to the reinsurance costs based on the claims that are actually being projected to be paid was to increase their deductible based on the inflation and the construction costs. So we're really seeing deductibles of $5,000 for water damage really becoming rare depending on the size of the building. For the smaller buildings, it's potentially still there, but for the larger buildings, we're seeing a lot of cases a minimum of $25,000 water damage deductible, especially if you're attempting to get quotes on with new insurance companies. So what's really important to discuss this with regards to the governing documents and the legal framework of how this all works is that the DC Condo Act stipulates that the master policy is primary when 2 insurers cover the same loss, right? So the moment that the loss exceeds the deductible for the association and there's damage to property that's considered original specifications to the building conveyed by the developer, then the master policy would be deemed primary. So if you carry a higher deductible, there's a less likelihood that the loss will not exceed the deductible, and therefore the master policy will not be primary. So in a lot of cases, if you carry these higher deductibles, it could benefit the association as a whole because it could prevent the smaller claims from having to be filed under the master policy. In addition, the DC Condo Act allows the association to assess the deductible up to $5,000 against the unit owner if the loss originates within their unit. Now, there is a caveat to that law prior to the words max of $5,000. It does stipulate that if the bylaws state otherwise a responsibility of the deductible, that they could assess more than the $5,000 deductible. So that's how the law has been interpreted over the past 10 years. So it's really beneficial if the associations have not already done so, is to amend their bylaws to allow for a more explicit reading or interpretation of their bylaws to allow for an assessable amount more than 5,000. So, you might read language in bylaws that says the association may assess the deductible in any amount against a unit owner if a loss originates within their unit, or may assess any deductible amount carried by the association at the time of claim due to misuse or negligence on behalf of a unit owner. Those are kind of the languages that you would want to see within your bylaws because it clearly states the deductible in any amount. And the attorneys have interpreted that in a lot of cases to mean that that supersedes the $5,000 cap granted by the DC Condo Act. There is work from what I've heard with regarding potential legislation in DC to increase the amount or the cap from 5,000 to anywhere from between 10 and 25. So that has not been finalized, but that is potentially in the works. And it's definitely something that we would want to see happen moving forward, just to help mitigate some of these costs for the association.
Real quick on the insurance, on the bylaw amendments. It's generally a good idea to get your attorney involved, but also to get your insurance agent involved if you're amending anything in regards to the how the bylaws read and restrict insurance. So, and
Yeah.
most agents are happy to help you. I know Joey is.
Yeah, absolutely. I have sample language that I've crafted for plenty of attorneys to review. So it's almost you can skip a step, work with me, and then send my draft to the attorneys, and it makes the process very simple. And I'm happy to do that with any of my clients. Yeah, so that's important to note, and we'll get into this a little bit here at the end about budgeting. But one of the big ticket items that I highly recommend, especially for associations on the larger side that are carrying $25,000 deductibles, is within your budget for the upcoming year is to add a line item for insurance claims to help self-insure. And by just adding one or two insurance claims within your budget as a line item for your deductible amount is really beneficial to project having a claim or two, because just dealing with as many associations as I have, it's very, very rare for a community association to go more than 3 years without having one or water incident that would potentially trigger an insurance claim. So having that built into your budget could go a long way with keeping your insurance premium stable. So this is everyone's favorite topic. So average premium increases and trends and outlooks. So over the past 3 years, after the inflation that we saw with COVID, we saw premiums regardless of the account's loss ratio or loss history average anywhere from 10 to 30%. Kind of the mean average would probably between 15 and 20 was kind of the norm. The range was about 10 to 30. But if you got non-renewed, that 30% was out the door. You potentially saw at least 100 or 200%. But the general rule of thumb was 10 to 30%. The good news is the first quarter of 2025, we've seen the average really be between 8 and 15%. And I've started to see increases under 8% going into the third, or, being into the third quarter of the year. So that's a really good place to be. That's a real good sign that we're seeing, a stabilization in the premium increases that we've seen the last 3 years. So that's a good sign that we're seeing the average increase now between 8 and 15%. A lot of associations, if you've been on the board for a really long time, you know that we were in a soft insurance market for about 10 years where the average increase was anywhere between 0 and 6%. We're not there yet, but hopefully maybe if we have a good hurricane season and keep the natural disasters down in America, we could potentially be looking at back to that maybe 0 to 6% increase range by 2027 would be a good goal. Okay, so what can be done to mitigate claims and increase market availability? The big one is updates, right? So the big ticket items, when I send a risk to get a quote for insurance, the big ticket items that the insurance companies ask for older properties are: when was the roof last updated? When was the electrical? When was the plumbing? When was the HVAC heating and cooling system updated, right? So those are the big underwriting, that's the big underwriting ticket items that insurance underwriters review when determining whether they'd consider quoting the risk, right? So they want to make sure that the roof is in good shape, that there's not going to be, any water or saturation issues on the roof. And it's also a good indicator on how well the association takes care of their building. It's kind of like just a test as well. If we have a reserve study and it shows that the useful useful life of the roof expired 10 years ago and they still haven't done anything about it, it kind of is just more of a red flag than anything. So just that proper maintenance, showing that the associate, I know that not everyone's financial situation is the same, but I'm just telling you how it is from an underwriting perspective. So an underwriter seeing that you are maintaining your building in a timely manner and according to the reserve studies goes a long way from an underwriter's perspective. Electrical and plumbing. Plumbing is obviously everyone knows that plumbing is a huge issue for the older buildings in DC. So doing everything you can to prevent water damage claims. Highly recommend water damage sensors. They can go a long way. They're not going to prevent water damage from happening, but they would prevent the potential water damage from turning into a claim, because the water sensors themselves would help alert them and shut off the water faster. So maybe that $2,000 water damage issue doesn't turn into a $25,000 or a $30,000 water damage issue, right? So it's not going to prevent the water damage. It's just going to prevent it from becoming a potential claim. But there's also different plumbing things that the associations do. They can do plumbing exams throughout the building. They can do hydrojetting. Obviously, get a professional in there before you do that, because that can cause other issues as well. But if the plumber recommends that's something that can be beneficial, that's also something to consider. And a lot of buildings in DC, the truth of the matter of the fact is that a lot of buildings are due for a total renovation of the stacks and risers and stacks. So if it's time and within the financial means of the association, I mean, that goes a long way with insurance companies, because old plumbing is a huge problem for insurance underwriters. From electricals, go ahead,
I
Sam.
just want to go back to the water sensors because, I'm a big advocate for the water sensors.
Yes. Yeah.
They're very cheap, guys. They're like $20, like the cheapest models are like $20. So for like $20, you stick it near your hot water heater. Like I've had plenty of associations where we've installed these prevention plans and they do work. So, highly recommend, going into the fall, just having the conversation with your boards about how you can prevent water from getting places you don't want, because this is a very affordable option. They do have more advanced ones that'll ring into,
Yep.
like they have apps and subscriptions and you can spend hundreds of dollars on them. But for $20, you're potentially saving yourself and your neighbors and headaches. So again, please, water sensors are the way to go. From the insurance
Yeah.
perspective, but us also just keeping the residents and owners happy.
Yeah, absolutely. And you can, even as an association, buy them and look to build them back. And I know Sarah, EJF Maintenance has done some projects at some of my associations on the installation side too. So it could be it's a lot easier project than you might think it is. So it's definitely highly recommended. The electrical, so electrical being older is can be problematic. The big issues are if you have aluminum wiring, fuses, or Federal Civic stat lock breakers. That should be your number one issue you should address at your property if you have those. That's typically an automatic no from all insurance companies and even some not admitted companies. If you have any three of those, I would highly recommend putting that in your budget over the next 2 or 3 years and getting that addressed as soon as possible, because those are significant issues from an underwriting perspective. So water damage reserve study, making sure that that's up to date and you're staying with the reserve study and you're making renovations in accordance with the reserve study. That can go a long way. Preventing water damage claims. So we went through water sensors, water damage maintenance programs. I've worked with plenty of associations on drafting that. I'm happy to do that again with my clients that I currently have, or anyone I have an opportunity to work with. That consists of many different things. We went through hydrojetting, water sensors. A big issue is HVACs, right? Mandatory HVAC inspections. That's something that I would recommend all associations mandate if they can within their bylaws, mandating that all owners get their HVACs inspected and provide proof of the inspection. And then amending your bylaws, which again, we went through, making sure that you can assess any deductible amount against the unit owner, because that will go a long way in mitigating the association's costs in the event of a water incident. And again, I know these are 3 very expensive topics, but central fire alarm sprinkler system and 24-hour front desk with annunciation panels. One of those 3 things could potentially go a long way with an insurance company for older buildings. So admitted versus not admitted insurance companies. So briefly, we'll just go through this. I know we're running a little short on time, but an admitted company versus a non-admitted company.
You're on mute. I don't know if you intended to do that. It's like you were adjusting things. Still on mute. Okay, we'll give him a minute.
Sorry about that. So admitted versus not admitted insurance companies. So an admitted company is a company that is regulated by the state, and their forms are filed with the insurance commissioner, and they are backed by the state guaranteed fund protection for insolvency. So essentially, like I said, admitted companies, they file their rates with the insurance commissioner, and they also file their forms, and they're regulated, and they're backed by the state solvency fund. So if they are obligated to pay a claim and they go belly up, then the state solvency fund will back them up and pay for any obligations they're responsible to pay due to a claim. Not admitted companies are lightly regulated, and they're not backed by that state fund, but they also charge a lot higher insurance premiums and will take riskier associations that have a high risk profile or have been non-renewed due to claims. So that's the difference between an admitted market and a not admitted market. So not a lot, but there are plenty of associations that with the hard market over the past 3 years may have found themselves into that non-admitted market with much higher deductibles and premiums. Again, we are seeing associations starting to slowly get out of that non-admitted marketplace more recently than we had over the previous 3 years. So that's also another good sign that admitted companies are willing to take associations that are in the not admitted marketplace, or over the past 2 or 3 years, they were most likely not going to do that. So just a general overview on kind of what to discuss with your insurance agent and how to potentially best budget for the upcoming 2026 year. The one thing you definitely want to do is, just kind of have an annual review with your insurance agent on the loss history. So when you ask, what's the projected premium increases for 2026 and what we should be budgeting for come November 1st, right? One of the big indicators is going to be your insurance claims, right? So if you have a large number of claims, or, not a large number of claims, but one large claim, those two factors could have a significant impact on your insurance premiums and what they're expected to be for 2026. So that's definitely one thing you want to ask your agent, is to review the loss history. Assess the current deductible structure, right? So this is something you want to work with your agent. If you're carrying $1,000 or $5,000 deductible and you're a smaller building, it's definitely something you want to have a conversation with, because you're potentially leaving a lot of money on the table by carrying that lower deductible, just from a premium saving perspective and an accessibility amount against an owner if a loss originates within their unit. So just evaluating what your current deductible is, or if you haven't gotten hit with that increased water damage deductible that a lot of associations have over the past 3 years, you might be getting that hit coming up to the fourth quarter of 2025. So a lot of the associations already got that deductible increase, but you want to have that conversation with your agent, though, that if you are budgeting for a deductible amount, you're budgeting for the accurate deductible amount that you're going to be getting for the upcoming policy period. Exploring marketing options and coverage strategies. Typically, I wouldn't recommend just remarketing every single year for the sake of remarketing, but strategically remarketing your insurance based on the market conditions. So if your loss history has gotten better and you're in a good position to go out and remarket, it might be a good time this year, just with the softening market, to remarket the insurance. Now, if you're in a situation where you have a really, really bad year, and that's about to drop off for the 5-year period or 3-year period, it may be worth having that one more year of a 10% increase, and then going out to market with a loss-free account the following year, and then really increasing the market availability with an even softer potential market, and going out with a clean loss history. So having, a conversation with your agent on whether it makes sense to remarket the insurance this year is something that you would want to consider too. And then plan for out-of-pocket expenses, right? So you want to budget for an insurance claim. If you can afford to do so, I recommend at least budgeting for one based on your deductible amount and putting that in as a line item in your budget if you can financially afford to do so. So that's the totality of the presentation. So Sarah, I'm happy to answer any questions or discuss anything that has come up.
Sounds good. Thank you so much, Joey. So attendees, feel free to drop your questions in the Q&A. And I was delighted to hear that it's going down, though.
Yeah, it's a little bit. Yeah. We're seeing some.
Although I did have an older community recently. I'm not personally involved with this one, but they're faced with a 45% increase.
Yeah, so it's an
All
older
the marks
building,
with not
right? So
having
that's where it's
more.
the bell curve maybe be going down even more for like the newer buildings, and the older buildings are still kind of on the more tip of the bell curve. But as I kind of outlined in the presentation, if you're an older building, it's still harder to get insurance, or you're going to see more of the increases than if it's a newer building.
Mhm.
That's why updates are so important.
So when a new association approaches you, what type of materials do you need?
Yeah, so
that process of,
yeah, absolutely. So we pride ourselves on really doing a due diligence of understanding the building and going out to market, selling the association to the best of our abilities, because we don't just sell insurance to insurance. We don't sell insurance to community associations. We actually sell community associations to the insurance company. That's part of our job, right? So the more information that I can use to sell the association to the insurance company, the better off the association is. So typically I ask for a lot of information, but I typically ask for just specific documents, and then I do my own research and my own due diligence. And then I use those documentations to examine to see what kind of questions that I need to ask. So typically when I look to quote a new building, I like to see obviously that if I can get the full public offering statement with all exhibits, that gives me like a lot of information. I can get plots, I can do replacement cost estimators with third parties. I can get a lot of information from the public offering statement. I ask for the reserve study so I can see what updates have been done, and it asks what questions I know I need to ask, right? So if I see that a building was a roof was just updated, it's got a useful life of 23 years, and the useful life is 25 years, I know that the roof was most likely just replaced 2 years prior to the reserve study. So the reserve study gets me a lot of information, and it gets me the questions that I need to ask if I can't get the information. So typically what I like to see is the reserve study, the public offering statement, which would include the declaration, the plots and plans, and the bylaws. And then I like to see the current budget and financial statements to ensure that the fidelity bond limit is adequate. And the financial statements and the budget also give me a lot of good information. So I can see if there was a special assessment, what that special assessment potentially was for. It tells me how many employees you guys have, if you have any payroll. It tells me a lot of different things. So typically financial statement, budget, public offering statement, and reserve study is really what I need to get started. And then copies of current insurance program is obviously really beneficial too, because I obviously want to provide as much coverage as you currently have. And I don't want to reduce your insurance program. So having that as a base point on, typically I like to provide more coverage, but using that as a baseline of, okay, this is what they're carrying. I want to get to this, if not more, with any additional recommendations, while keeping the premium at the current rate or potentially trying to save them money. So that's a long-winded answer of public offering statement, bylaws declaration, reserve studies, and current policies is typically what I ask for.
a lot of good information though, because since I work with you regularly, I know it's a lot of work.
Yeah.
You ask a lot of questions, which is good. Because
But I don't like to Because what will happen if you don't ask a lot of questions is if you don't ask a lot of questions, you don't get a lot of answers, and you write the insurance and the loss control goes out there and you didn't ask all the questions and they find something and then they non-renew you when the agent could ask questions. We don't operate like that. I would never want to do that to one of my associations. So I like to get all the information up front so that we are not blindsided at all when it comes to loss control inspection. So that's why you really should ask a lot of questions.
Well, thank you.
Yeah.
Or no, thank you for all the work you put me through. Um,
Yeah, you're
a
welcome.
few questions in the chat. So somebody asked, will the recordings of this presentation be available on EJS website for viewing by board members and owners? Yes, there is a live link. There's a link that will be placed on our official website. We also send out this recording in the slides to all board members via email. And then we have another one. Our community has seen some big increases after getting solar panels installed on the roof of our 5-story building. Are you seeing that elsewhere?
Can they share where that building's located?
DC.
DC. Okay. Yeah. So it's becoming a little bit more commonplace. It's not like a wide range of insurance companies, but there are two insurance companies off the top of my head that will automatically not write the insurance if they have solar panels. So technically speaking, if you do install or have solar panels, the market availability has been reduced. There's plenty of insurance companies that will write the insurance if there are solar panels part of the building. So I wouldn't say it's totally problematic to have them. A lot of it though depends on whether the association is leasing the roof and they don't actually own the panels and they're not responsible to insure them. If that's not the case, then it shouldn't increase your limit just due to the fact that you don't have to actually insure the system itself. Now, if you own the system, you got to make sure that you're carrying in property insurance equal to the replacement cost value of the solar panel system. Typically, if it's kind of gotten to the point where it's almost universal, where a lot of insurance companies are requiring supplemental applications to be completed with regards to the solar panels. So if we do have an association that's going to add them, we typically send them that solar panel application. It's a little bit complex, but it's nothing a solar panel company can't complete. And most of my property managers that I work with have just sent that on to the solar panel companies to complete. I can also, if I have a copy of the contract, I've done it enough. I can actually complete a lot of the questions if the answers are on the contract. So generally speaking, I don't know the specifics exactly if there was any other factors at your building that may have also contributed to the rate increases. And the solar panel was maybe just another factor, right? Because it could potentially be like life insurance, right? If you had cancer and you're a smoker and you have high blood pressure and you have this, right? It's a combination of factors that could maybe affect your life insurance rate, but it's not the only factor, right? So it's hard without all the facts to say like, oh, it's definitely the solar panels that raise your rates and not other things and not the combination of those factors. But generally speaking, there are insurance companies that will not write solar panels.
Thank you. So somebody commented that this is a lot of information to take in, and it is. It's a lot of very good information. So really recommend that you reach out to your insurance agent or your community manager and suggest to the board that all of you meet your manager, your insurance agent to renew your next policy before actually renewing the policy, but when you get the draft, so you can go through all the specific things that tie in, because there's so many different factors that's taken into consideration. And then somebody asked, wood burning fireplaces are a high risk factor. What can be done to reduce this factor, short of removing a fireplace?
Yes. So you definitely check with legal counsel before you remove fireplaces, because I think that's, if the unit was sold with them, I think it can be pretty problematic. But generally speaking, yeah, wood burning fireplaces are an issue. Some insurance companies, again, will not quote buildings that have wood burning fireplaces. So that does potentially reduce your market capacity. But what I've worked with plenty of associations, and I have a very simple, straightforward template. It's a notice to owners requiring them to have their fireplaces cleaned out and inspected every 6 months. And it's a simple one-page document, and they check do not use, has been inspected, and they send it back to the board. So a lot of my associations have implemented that protocol that have wood burning fireplaces, that they get their system fireplace inspected every 6 months. A lot of cases actually are mandated by the insurance company via loss control recommendation. So if any association has that and they want to reach out to me, I can provide you my very, very general template that even if you guys want to potentially buff up, you could, but it's very generic and you guys could use that if you'd like.
And then somebody asked for a copy of your recommended bylaw amendment language.
Oh, yeah, definitely. I can send it to you, Sarah, and then you can send that off. Is it a,
It's I believe, a DC association.
yeah. Okay, I'll send that to you, Sarah.
Okay. All right. We still have a few more moments, so if there's more questions, feel free to drop them in. I know chimney fires are no fun.
Yes. Yeah.
Thankfully, like knock on wood, I've never had to experience a chimney fire in a multi-unit building that I've worked with previously.
Yeah.
But getting those fireplaces cleaned out is definitely
Yeah.
one of the
Smoking
things.
is also a big issue too. I've had 2 fires caused by smoking.
Oh, really?
Yeah.
Is non-smoking language a factor for
They
insurance?
don't take it in perspective now. I mean, the only reason it would be an issue is if you had a fire that was caused by smoking,
Gotcha.
then yeah, it's more like, well, do they still allow smoking? No or yes, that could potentially um, play a big factor on whether they quote it or not. But pre any claim, they don't ask the question.
Interesting.
Yeah, it is kind of interesting.
In
I think,
2011, I had uh, a unit owner unfortunately passed in a fire due to smoking
yeah,
with their
so,
apartment on fire. It was devastating. It took the associate
yeah,
a while to get things turned around.
yeah, that's really sad.
So
So is there 6 questions, or are you already asked them?
I already asked. Yeah.
Oh, okay, I see. Yeah.
Yeah. Just giving people a bit more time if they want to ask
Yeah.
more questions. But I think we're good at this point. Well, thank you so much, Joey. It's been a pleasure. Really appreciate it.
Yeah, absolutely. Thank you so much, Sarah. I really appreciate your time, and I hope everyone enjoyed it.
Yeah. Take care. And thank you for all the board members that attended today.
Yeah, thank you, everyone.